Welcome, folks, to the What Does It Mean podcast, where through our conversations among the three of us, and from time to time, with folks from companies, market strategists, market analysts, and other thought leaders, we will look to inform you as to what's going on in the market, in the economy, and so much more. We'll be blending fundamentals, technicals, thematics, and our own boots-on-the-ground research to tell you and your investors what is happening in the market and, yes, what it all means. So who is behind this podcast, this cast of characters that will be bringing you these insights each and every week? Well, there are three of us, as I said, and let's start first with one, Lindsey Bell. Lindsey, give us the 411 on you.
Yeah, sure. Hi, everybody. I'm Lindsey Bell. So I have a broad background in the financial services industry. I've been working in the industry for 20 years now, studying markets most of that time. I started in investment banking. I worked on the sell side. I worked on the buy side with Jim Cramer and you guys, which is how we met, helping to manage the small mid-cap portfolio for Jim Cramer back in the day, but also interviewing you two and other experts on video there, including Jim Cramer and Stephanie Link. And now I've been dabbling in my entrepreneurial interests, and I started a newsletter called The Shift, where I dig into labor market dynamics. I also keep a close pulse on the market still. So that's me in a nutshell.
All right. Well, Bob, let's wheel over to you. Bob Lang over at Explosive Options and longtime contributor to Real Money Pro, now packaged as the Street Pro.
Yeah, Chris, great to be with everybody, and also great to be with you and Lindsey. You and I, of course, have done some podcasts in the past. Lindsey and I, some years back, did some webinars together, very, very successful and real popular. So this seems like old hat to me. But, I'll tell you that being able to inform everybody about things market-related, economics-related, we really don't hold any restrictions on where we can go as it relates to markets and so forth. Getting your perspective, getting Lindsey's perspective and mine, maybe from a technical point of view or an options point of view, is really going to be a fascinating dynamic here for the audience. Now, a little bit about my background. I, as you said, I've been working with the Street for the better part of about 15 years, started with them about 2009. I have my own company called explosiveoptions.net. Which I started in 2011, and I have a chat room and so forth. And through that chat room and through the services, I've done a lot of interviews with some important people in markets, yourself and Lindsey as well, especially. It's going to be a great time to help teach people and show them what we're thinking about markets, trying to get ahead and trying to explain, what's it all mean.
I think that's a great perspective, Bob. And I didn't really say who I was, but I'll bring up the rear, as it were. I'm Chris Versace. I run the Street Pro portfolio, formerly known as the Action Alerts Plus portfolio, but I'm also the Chief Investment Officer over at Thematica Research, where we build thematic indices and models, some of which power ETFs over in Europe, but we've also got some RIA clients as well that are using these targeted exposure models. That's kind of a quick introduction of who we are, but I know you're going to be hearing a lot more from us each and every week, getting to know us a lot better and how we think. But as we get ready to launch on this endeavor, begin, as it were, Bob, for somebody who's new to us, what would you say this podcast is going to be about?
Well, I think this podcast is mostly going to be about our views, and anybody else who comes on the podcast with us to give a different perspective, a different flavor of what's happening in markets and in the economy and so forth. I have a strong background in following the Federal Reserve, Fed policy, all the people on the board over there. And you've asked my counsel on many occasions about, what my spin is on where policy is going. There's such an enormous link between markets and monetary policy. We heard Chair Powell last week talking about monetary policy and the importance of being independent from the government and so forth, and the importance of laying out the right policy in terms of timing for the economy and eventually for markets. So that's my perspective, of course, with technical analysis and so forth. So I think to answer your question, I think we're going to give everybody a very well-rounded and complete view of things from our perspective.
Lindsey, as we turn from Bob, the counselor Lang, to you, anything to add to that? Anything that we're hoping to accomplish as we share and impart our collective wisdom with the audience here, who is a combination of individual investors, RIAs, and other professional investors?
Well, I think that the unique thing that the three of us are going to bring to the table is our ability to drill down into the details, but then to like zoom out. And that's what this is all about, is to zoom out, right? What does it all mean? So to give that, I don't want to say 30,000 foot view, because I think we get a little closer than that. I like to say 15,000 foot view, the amount of time I spent as a chief investment strategist at Ally and other places. To me, that's what it's all about, being able to kind of take a step back and really understand what the details are telling us and what to do with our money from a broader perspective.
I agree. The only thing else that I would say is, I know that from time to time, the market, to use your language, Lindsey, really zooms in very close. It feels like we're thinking about the next couple days, maybe the next couple weeks, but there are things that unfold over months. And sometimes it takes certain investments, 12, 18, maybe even 24 months to really unfold. And sometimes you have to be patient, and you have to really pay attention to the data. I was looking over the Street Pro portfolio the other day, case in point, this one position that we have, United Rentals, in there. And I mean, it's up significantly, but what I didn't realize is we started buying that in 2022. Just an example that sometimes you have to let the thesis play out. But again, these are some of the things that we'll be talking about in our conversations each and every week, mixing in other thought leaders and other perspectives as well. So folks, with that, as I like to say, the 411 introduction to the podcast, stick with us, because after this short break, we'll be right back digging into the big conversation of the week. All right, folks, we're back. That's right. Time to drill in and say, what does it mean with all this stuff that is happening this week? I'm going to turn right to the counselor himself, Bob Lang, because he did mention the Fed. Bob, on Monday, Fed Chair Powell spoke. Anything new? Because I heard what he said, and I got to be honest with you. A lot of folks were saying, Powell is saying he's not going to wait to get to 2% for inflation. But I hear it, and I'm like, he already said this. So what might I be missing, Bob?
So Chair Powell had an interview with David Rubenstein over at the Economic Club yesterday, about noon on Monday, July 15th. And as Chris said there, he didn't say a whole heck of a lot different than what he said on the Hill in his twice yearly testimony last week, nor did he say anything different than what we read in the minutes the prior week, nor did he say anything different from the statement and his press conference the following week, prior week. So I don't really see that anything that's changed in terms of policy. The only thing that I see structurally, Chris and Lindsey, that's really changed is the market is taking his words as being a little bit more aggressive towards rate cuts. And now, as we see today on July 16th, the Fed funds futures are looking at about almost exactly three rate cuts in 2024. Well, let's do the math here on when those rate cuts could happen. We have 4 meetings left in 2024. We have the end of July, September, November, and December. And of course, the November meeting is the day after the presidential and congressional elections here in the United States. So I really don't know where Chair Powell was trying to go yesterday, other than reiterating what's been said for the past few weeks. He did say, as you mentioned, Chris, that this is one little point that the market has forgotten about, is that the Fed is going to make changes in policy, cutting rates versus leaving rates where they are, as we make a move towards 2%, not at 2%. So we're making that glide towards 2%. It's taking a long time. And you and I talked about the core inflation, the personal consumption and expenditures. It's taking its sweet old time trying to get down towards 2%, but we're making that slow move towards that target. And when we do, we're going to see a little bit more discussion from the Fed members and Chair Powell himself about rate cuts.
So I agree with you, Bob, but there was a little piece in what Powell had to say when he was talking about overall progress on inflation during the second quarter. He goes, we've seen some good progress, but that seems a little more, I won't say wishy-washy, but it's not as dovish where you would hear that and you would say, 3 Fed rate cuts. So Lindsey, my question to you is the market potentially once again getting out over its skis with the number of rate cuts that we might be potentially getting in 2024?
Yeah, I think the market's getting over its skis again. I mean, three cuts this year. We still have mixed economic data. We are seeing a weakening, which is what's helping in disinflation occur. You need the economy to weaken for that to happen. But I think when you look at it, it is mixed data. You look at the retail sales that came out this week, right? They were stronger than expected. I mean, there's two sides to that coin. If you look at the real retail sales that accounts for inflation, it's been negative for 2 years. But on the headline, the surface, it looks pretty good, especially if you look at the core group of retail sales. So I think there's enough mixed data. If you talk to certain economists, they'll tell you that Powell says, hey, look, I want to see multiple months of progress, okay? And we've seen a couple months of progress. The first quarter of the year, inflation was much hotter than we had expected, right? And then we've seen a couple months showing progress. But we need more than 2 data points, right? So I think that the Fed, I think the retail sales data this week really just took July off the table for the people that were out there kind of trying to throw that in the mix. I think September
sorry, Lindsey, that 5 or 6% fringe group that thought we might get a rate cut in July.
Yeah, so I think that's off the table. I think September is a possibility, but again, the Fed is going to be data dependent.
I agree. And I wrote something last week where if you take a look at the year-over-year core PPI, and Bob, you and I had this conversation, and you smooth it on a 3-month trailing basis, it's actually higher in June than May. May was higher than April and so forth for, the last 3-4 months. And look, the market can think what it wants, but I think we would agree that something like that is not going to go unnoticed by Powell and this team. And I think that's kind of why his comment was more like, yeah, we've seen some progress. And to your point, Lindsey, he wants to see more. We're going to see a lot more. Bob, if I had to put a gun to your head right now, how many rate cuts this year?
2 rate cuts, 1 in September, 1 in December. But I would also say, Chris, the reason for Powell and the committee being a little bit more on the conservative side, I think the flogging that Powell got a couple of years ago when he introduced the word, remember transitory inflation? He was flogged all over the place. And I don't think he wants to go back into that mode again. So I don't think he wants to cut early. I don't want to think he's worried about cutting too late. Look, I mean, it's been a year since the last rate move, almost a year. At the end of July of 2023 was the last time they moved interest rates. It was at the end of July. They raised rates to 5.25%, 5.5%. We haven't moved off of that yet. If you look at the economy, we had a huge fourth quarter of 2023, slowed down a little bit in the first quarter, and it looks like we probably slowed down a little bit in the second quarter. But still, on an average basis of about 2% growth at 5.25% interest rate on the Fed funds, pretty extraordinary if you ask me. So I don't think the Fed is erred on the side of being too aggressive. I think they've erred on the side of being too cautious. And I do think that the balance of risks the Fed talks about, especially Chair Powell, is on being too tight for too long right now. They've been very restrictive in policy for the better part of 18 months. And I think as we move forward, I think that the method of bringing rates down is going to probably be a little bit more aggressive, especially as we enter 2025.
Okay, so Bob, you said 2 rate cuts, September and December, I believe. Lindsey, what do you think?
I think we get 1 rate cut in September, and I don't even know that we actually need it. I think it'd be more of a commitment from the Fed to just show that we're trying to do the right thing. This is a very fine needle that we need to thread. I think things are going to slow down enough that the Fed's kind of going to give the market and investors what they want. My guess is that they're going to have to take a pause as things reaccelerate probably into the end of the year, beginning of next year.
Okay. And when you say reaccelerate, are you talking inflation or the economy? Or
The
both?
economy,
Okay.
which may make inflation sticky.
Chris, where are you at on the rate cut?
Well, I had been for the longest time at 1 in December. And I will say that some of the more recent data has me softening that. I haven't made a formal change yet, but I do think it's possible that we get 2. But I agree with Lindsey that I think that, what I saw in that PPI data tells me that, the Fed's going to want to see, quote, more good data. So obviously July is off the table. To me, the question now is, when we start getting July data, what does it show? And I think that's the difference potentially between September, November, or just one rate cut. So that's kind of where my evolving thinking is. But Bob, I know you got a quick point to make it, and then I want to move on.
So real quickly about interest rates, we have to pay attention to what the bond market is telling us right now. And interest rates have been falling on the long end of the curve. And in fact, what we've seen on the yield curve is more of a flattening effect, much like we saw earlier in the year when the 2-year yield fell close to 4.1%. We're about 4.4 on the 2-year right now. And again, the market maybe is getting a little bit ahead of itself, as Lindsey said, over at Ski is a little bit more aggressive, but still, you have to pay attention to what the bond market is telling us here. And I think they're trying to get themselves in sync or slightly ahead of where the Fed is right now. A little dangerous, I suspect, but still, the bond market tends to predict a lot of things wrong. I think they predicted 6 of the last 2 recessions. So, so it's a paranoid market. I've experienced it with working with bond players before, but I think this is really important to pay attention to interest rates.
All right. So, Lindsey, if we think that the market might be getting out over its skis with the number of rate cuts, and yet the S&P 500 has been, up until very recently, hitting new highs multiple days in a row, are you a little nervous about this market, or do you think it's got some legs?
I'm a little nervous, and I feel like, I don't know if you two are, but I feel like I'm getting nervous, and I'm typically, for history's sake, I'm pretty optimistic usually when it comes to the market. I remain upbeat most times, but I'm getting a little bit nervous because of what I see in the labor market, which I equate to a stalling out of labor demand. And, inflation is cooling, which is good. But like I said earlier, inflation cools when the economy is weakening. You look at the City Economic Surprise Index, the surprises have been to the negative side. So numbers are coming in worse than expected. And just looking at, we're at the very beginning of earnings season right now. And I think we'll get into this a little later. But what I'm hearing from executives and what I'm seeing in the numbers is that it's a great second quarter so far. It's good. I think the numbers are going to come in great. But the outlook, it has been cautious. Now, we've only heard from a couple consumer staple companies, the banks, it's the early guys, and usually things can get off to a slow start. So we'll definitely keep our eye on it, but it is showing that the consumer is slowing, and that's been the one resilient part of the economy. You hear a lot of people talk about the different rolling recessions that we've had over the last several years. Well, the consumer has been the one that has remained resilient and strong throughout. And I think we're starting to see cracks in the consumer, which is 2/3 of our economy. So that has me worried, but I don't see this as the beginning of the end. What I see it is a slowdown. I think corporations are getting a little bit cautious going into the election because, just look at what happened over the weekend was kind of a black swan, unexpected type of event with the attempted assassination on former President Trump. And there's a lot of time between now and November, and we don't know what happens actually in November. So I think corporations, you're starting to see a couple CEOs, you're starting to see executives, and you look at the ISM services survey, they take commentary from some of the people that they interview. The election is coming up, and so it's weighing on people's minds. There's other surveys that show that political leadership has moved up significantly on the list of concerns, where inflation still remains at the top for corporations. So I think that the outlook and the spending that has been happening over the first part of this year could slow at least into the third quarter, potentially into the fourth quarter, before we get a rebound. We get past a lot of this uncertainty, especially related to the election. And also and we could talk ad nauseum about, AI and the impact that's having on the market. I think that's also causing a sense of cautiousness, or at least a a slowdown in spending with regards to other parts of the CapEx structure, not just in AI, right? But also in talent too. So I think all that leads to a slowdown in the economy near term. Again, I don't think we're falling off a cliff. I just think we're taking a pause.
Are there some bright spots that you are seeing though, Lindsey? And I'm asking because, we hear a lot of companies continuing to talk about AI. We obviously saw a trifecta of big, high-profile cybersecurity attacks, Ticketmaster, AT&T, Disney. That's kind of a reminder that cybersecurity, remains a key, or should remain a key focal point of the C-suite in terms of IT spending. Some of the underlying non-seasonally adjusted data, like housing starts has been actually favorable. We know we have the flow of infrastructure spending and related programs. So I understand that you have some concerns, but for the optimistic Lindsey that's in there, is there anything that you're very encouraged by?
Yeah, no, I think you mentioned a lot of that. I think AI is definitely going to be a tailwind for the market. The AI revolution is certainly underway, and I think in very early innings. I don't think that that's reflected in earnings estimates, even for the biggest players in the space. So I think that there's going to be optimism there. I think the infrastructure spending is going to be a great tailwind for the economy over the longer term. I also think one positive out of the banks, I would say, is capital markets have been strong, and that's been a weak area for the banks. And so if you're a big diversified financial institution, at the reopening of markets, lower interest rates actually helps deals get done. It helps the housing market, right? And so I think there are pockets of positivity too. I just worry about the consumer in the near term, but I think things are going to work themselves out.
So Chris, let me pivot off that for a moment. With all what you and Lindsey just laid out there, we could have a completely flipped administration next year in 2025. How does that change your thesis, Chris, in terms of growth in the economy and so forth? And obviously, maybe a new Republican administration might be favoring tax cuts and easier energy policy, that sort of thing.
Less regulation, that sort of thing. Yeah. I mean, look, it's a valid question. I would just say that I think it's way too early, right? I know that there was a big wave of enthusiasm for the Republicans, coming off of the event that Lindsey mentioned, over this weekend that obviously surprised everybody. I was at a Savannah Bananas baseball game when I heard about that, and I felt so bad, for the teams playing, because the entire audience at National Stadium just froze. Everybody was looking at their phones. So, obviously it was a big moment. I think the immediate follow through on that is one thing, but look, we've got a way to go until the election actually happens. Some things may change. I mean, Bob, we might even see some of the players change before we get there. So I would hesitate to kind of prognosticate this early on, but it will be something that happens. But I do think Lindsey's point that level of uncertainty is something that could influence how companies talk about the back half of the year.
Yeah, and I think too, with elections, typically this is a time of year going into the November vote. Usually you see the market do extremely well. But I just think there's just a level of uncertainty, Chris, that you just said that the Democratic candidate could possibly change. There's so many things and so much time between now and then, and even right after the election, how it's digested by markets, by the country, by the world, I think too is something that we're all going to have to watch.
3.5 months. I mean, it's more than a quarter, right? It's a long time.
Lindsey mentioned that uncertainty here. We can see that in terms of dollars in the markets. And what I mean by that is if you look at the volatility, VIX futures term structure, there's a huge rise. Currently right now, the VIX, the volatility index, the fear index is trading at around 13%. There's a huge rise, Chris and Lindsey, in October, November futures, about 45% higher than it is right now. So what the market is anticipating or pricing in 3-4 months from now is volatility, market volatility. Now, this happened about 4 years ago and 8 years ago, the last two elections, and people who had bought volatility going into the election ended up paying for it because volatility collapsed right after the result happened. That's usually what happens, right? The volatility starts to rise as uncertainty is created, and we have a lot of uncertainty right now, of course, who's going to win this election. Once that election result is completed, we see volatility collapse. And when volatility collapses, we usually see a nice run up in the market. So I'm fascinated by this huge spike in volatility out in October, November. Again, people are expecting a lot of huge moves in the markets 3-4 months from now.
Well, let's talk about a recent big move in the marketplace. I think I read somewhere this morning that the Russell 2000s had its best string of 5 days in, I think, almost forever. There's a lot of folks that are reading into this as the market rotation, potentially out of AI and big tech to other areas of the market. We are seeing some other areas of the market that haven't been working. They are working now. Some of them are these more interest rate sensitive areas. But Bob, in terms of the Russell 2000, when we were chatting about it, I think you said it's a moment to frame. What do you mean by that? Why is this important for listeners to pay attention to?
Well, that seems a little underwhelming now. I'm going to say it's breathtaking, to be honest with you, for this move that the Russell 2000 has made in the month of July, over almost 10% in the past 6 sessions, Chris and Lindsey. It's amazing how well these small caps have done. And we can correlate that directly with the drop in interest rates. And that drop in interest rates happened when that better than expected CPI number from June dropped on Thursday, July 11th. And once interest rates dropped on that morning, it was like, ringing the bell all of a sudden. Okay, small caps are where we're going to go. The NASDAQ and the S&P 500 had a great first half of 2024, up nearly 18 to 20% for each one of those indices. The Russell 2000 coming into the second half of 2024 flat for the year. So there was a lot of catching up to do. Either the large caps were going to come down or the small caps were going to come back up and take the baton. And that's exactly what happened. It's been a stunning run. But interestingly enough, Chris and Lindsey, is that, the Russell 2000, after this strong move up here, still 5.5% away from an all-time high. The IWM at 230 is the all-time high. We're at 218, 219 right now. So a good 5% move up would get it up to an all-time high. Join the Dow Industrials, the S&P, and the NASDAQ where they're at all-time highs. So still a little bit more work to do with the Russell 2000, but I tell you, the last 4 or 5 days have been breathtaking.
All right. So as Bob just said, Lindsey, breathtaking. But as we talked about a few minutes ago, even the counselor himself said he doesn't see 3 rate cuts this year. We're concerned a little bit about the economy. My question to you is, Lindsey, do the fundamentals align with this move that we're seeing in the Russell 2000 or not?
Yeah, see, that's where I get a little concerned. You kind of just heard my spiel on the slowdown that we're going to be dealing with, and that doesn't really bode well for the small cap trade, right? That's not to say that the small cap trade can't keep going in the near term. But when I look at the fundamentals, I look at the S&P 600 earnings estimates, and what you see is that they're improving, but they've been negative for a while now, and they're about to turn positive. But it's not like this massive catch up. They're slowly improving. And what do the small caps need to work in their favor? Primarily, the biggest thing that benefits them is lower interest rates. And I think that's a lot of what the market's getting excited about, is that interest rates are going to come down. But we're still going to be in a higher for longer regime, right? And so even if we do get several cuts, and that's the goal, to get a handful of cuts and then just, resume back to the neutral level, whatever you believe that is to be. I believe it's probably around closer to 3% on interest rates, the neutral rate. So you want to bring interest rates down a little bit. But I think for small caps to do really well, you want to see a bigger, swifter move lower. But a swifter move lower in interest rates mean the economy is weakening more significantly than we expect. So I think this is a trade that could take time to play out, but sometimes the market thinks far ahead and gets super excited and moves faster than what is potentially rational, right?
Oh, Bob, there's that word I like to use. Lindsey didn't say it, but she just gave the textbook definition of hopium.
Hopium, that's right.
Right?
Yeah.
So if I parse kind of what we're saying here is, it sounds like as impressive as this move in the small caps are, it too could be a little overdone, depending on some of the data that we might get. But I would also throw in the earnings season is really going to matter, right? I think a week ago when the S&P 500 was hitting those new highs, it was arguably oversold based on the RSI. Bob, I know you might have some other, thoughts on that from a technical perspective. The S&P 500 multiple is stretched at over 23 times. We need to see earnings growth really accelerate above and beyond what the market expects, 11, 12% year over year in the second half, or the same range compared to the first half of the year. So I really do think that the next leg of the market is going to be more determined by what we see over the next 3, maybe 4 weeks, when some of these big cap companies, call it Apple, call it Meta, Amazon, Google, and the like, report, but then a whole array of other companies do the same. So I think that certain sectors will continue to perform well, but we as investors know that we don't buy the market. That's not our job, right? Our job is to look for opportunities, whether it's call your flavor ETFs or just individual stocks that are poised to outperform. In my experience, that means superior earnings growth. So that's kind of my area of focus, at least for now. Any thoughts on that, you guys?
Yeah, no, I would say with regards to small caps, we did see another rally, and Bob probably is more lasered in on this than I am. But at the end of 2023, between the end of October and the end of December, small caps rallied 25%. And before we started consolidating into this move that we're currently seeing, and earnings during that time period for small caps were acting very impressively. So they were still pretty weak. So I think that the market can be irrational. Is it the Buffett saying the market can be a lot more irrational for a lot longer than you can remain solvent? So I think that too, like you just said, Chris, it's really important. You look for opportunities within your time frame, right? So I might not think that small caps is a long-term play, but it doesn't mean they can't perform well over the next 8-10 weeks,
You just made a great point, Lindsey. It's not something that we talked about, but as folks try to get a little more familiar with us and our different perspectives, I think they need to know, what are our time horizons, right? Because we each have different investing styles. I'll go first. I mean, I'm more like 12 to 18 month, 12 to 24 month type of investor. I like to really let things play out. Sometimes I'm early, but as long as the data supports what I'm, the thesis that I'm building, I'm fine with that. What about you, Lindsey?
Yeah, I'm longer term like that too. 12 to 18 months is usually what I'm looking at.
All right, counselor, are we calling you quick draw, or what's the story?
I'm looking at both, short and long term. I think fundamentals always win out in the long run, but you have to take a look at the technicals as well too. The technicals will support movements that are made in the short term. We're talking 3 to 6 months out there, because the technicals kind of give you an insight into the trader and investor's mindset, the emotions that are playing out, momentum in the markets and so forth, and how people react and respond quickly off the trigger to what's happening in the moment, right? I think looking at both long-term and short-term is extremely important. And I'm looking at, Lindsey had me, triggered me to look at the longer-term Russell 2000, for instance, and you can see that after it bounced from the 2020 lows and from the COVID lows, and it had a humongous bounce to the all-time highs in 2021, it's been basing for about 2 years. And frustrating everybody who's been waiting for a Russell 2000 breakout, because all the other indices did break out except for the Russell. And now it's finally pushing out and finally playing catch up. And who knows, this thing could have a long way to go. I want to say that, Chris, didn't you mention something that Tom Lee mentioned a couple of days ago, that he saw a 50% gain in the Russell 2000 in 2024? That's from the start of the year to where we're at. We're up 8% right now. So he sees huge upside in the Russell 2000 by the end of the year. Is that right?
I did not share that with you. So I'm fascinated by that. I'm wondering who this other Chris is. Maybe we should get him on the program.
Yeah, so that I did happen to hear that last week. So I apologize. Maybe I didn't share that with you, but I did mention that to a colleague of mine, and it was stunning to believe that he thought that the Russell 2000 was going to far exceed the NASDAQ, which has some of the bigger names that we've always discussed, the Mag 7 and so forth, and the Dow Industrials, which has been outperforming all the other indices, even the Russell 2000 over the past 2 months. But to see that 44% from now 50% gain in Russell 2000 is pretty stunning, if you ask me.
I could not disagree. All right, let's get into some quick hits real, because we've got to get moving here. Between now and the next podcast, right, which will be out next week, same day, Thursday, Bob, give me one thing that you'll be paying attention to, and only one.
I'll be watching the our earnings, Chris, and I think you and Lindsey laid it out very nicely about how the bar has been raised for a lot of our companies right now with earnings, and we got to see good, strong earnings, good, strong guidance going forward into the end of 2024. And we're at the point right now where if a company hasn't made it this year, they're probably going to throw in the towel on 2024 and start looking ahead to 2025. And again, a lot of uncertainty out there. As you mentioned, Chris, we really don't know who's going to win the election or what policy is going to be like, fiscal policy and so forth. So I'll be watching earnings over the next week and a half.
That is so
Lindsey?
not cool, Bob. You totally stole my answer.
Yeah.
Well, let me see if I can help you, Lindsey. As the pace of earnings heats up, is there any one particular earnings report that you'll be focused in on between now and when we talk next?
You know what? Instead of looking at one specific, because I'm going to look at all especially the big dogs, but I think what I really am going to keep a close eye on is operating margins to see if they can continue expanding across the board, not only in this quarter, but again, what does that outlook look like for margins? Because I think even as sales expectations come down, and I do expect them to come down because of inflation cooling, how is that flowing through to the operating margin line?
That is a great point, Lindsey, because everybody's so focused in on that top line when it comes to inflation. We have to reconcile that costs for companies will also be coming down, and if they can move those costs down the cost curve, can't say that 3 times fast, move the costs down the cost curve faster than the lingering benefit of price increases recedes, that is margin, right? But I also think, and listeners, we talked about this, a couple of days ago, the three of us, we were talking about PepsiCo, right? Which is a great example because, Lindsey, I know you have some concerns about their top line, right? As some pricing has to normalize, but it's a reminder that you really have to look under the hood at these companies because there's something very specific regarding PepsiCo and the rebound in its Quaker business that should allow it to continue to deliver growing margins, even if the top line might be just a little slower than what people were thinking for. But that's a great call out. I'm going to get very specific, though, unlike the two of you people. I'm going to say earnings, but guidance from Taiwan Semiconductor will be key. And I say this because its two big end markets are high performance computing and smartphone. These are the areas of focus going into the second half of the year, along with PC, about AI. So their outlook for those 3 end markets will be key for the big dogs. I'm talking NVIDIA, right? We're talking Apple. We can lump Qualcomm in there. I would throw Marvell in there. And I would say, gun to my head, the second thing to watch over the next weeks will be spending. Microsoft, Meta, Amazon, and the like. So with that, we will be right back and wrap up this first Begin the Begin podcast in just a moment. All right, folks, that was our first Does It Mean podcast. You can see we're working out the kinks, but as you can also tell, there's a lot of brain power here, a lot of insights and a lot of smarts that you'll want to be paying attention to. We'll be happy to be sharing that with you. But before we wrap up, I just got 2 questions to both Bob, Lindsey, and of course, I'll be putting myself under the microscope as well. Lindsey, from our conversation, was there any one thing that you're walking away with going, I may not have known that?
Well, first of all, Bob's pet name, Counselor.
The Counselor.
But so that will stick with me. And it says a lot. But no, I think, Bob, you laid some knowledge on me today that I liked about the small caps when you reviewed the consolidation that had been happening for over 2 years before the recent move. So we know it can be like a springboard. So I'm going to take that away when I think about the fundamentals of the small caps going forward.
Bob, you?
Well, I'm going to throw it back at Lindsey because Lindsey, I appreciate her positiveness and generally, I want to say bullishness in this market, giving the benefit of the doubt to the buyers, but still having that reserved, cautious viewpoint and letting the companies tell her how to proceed as opposed to trying to tell them what to do and tell the markets what to do. So I think that's a great approach and why she's demonstrated so much success over the years in every place that she's been, and showing how to be patient and wait for the companies to deliver and tell her what to do.
All right, Bob. Lindsey's going to be here every week. No need to pile it high and deep so early out of the gate. Jeez, come on. We know she's smart. That's why she's here. Jeez.
So, it's right.
All the right moves.
Yeah. So I'll say that, I can't believe I said that. Now I have to give some props to Lindsey as well. It's, of course, just her comment about watching margins throughout the upcoming earnings cycle, because I do think that's going to be a key point to focus. And it ties in a little bit to what I was saying about earnings expectations for the second half of the year. Okay. Real quick, because we are running a little long out of the gate. We do like to chat. Hopefully the folks like that. But between now and next week's episode of What Does It Mean, Lindsey, where can folks find you if they're looking for you? And they should be.
You can find me on Twitter at JustLBell or LinkedIn. Lindsey Bell at LinkedIn. You'll find some of my newsletter thoughts on the jobs market. And my newsletter is The Shift, which can be found at www.lindseybell.me. Please go sign up. I send a newsletter every week on Friday morning. So hopefully you enjoy.
And I think, Lindsey, the folks at Advisorpedia are going to be showcasing some of that content from time to time.
Yes. Last week they shared one of my pieces, so you'll find it there as well.
Excellent. So I guess that means you can also go to Advisorpedia, type in Lindsey Bell, and you'll start to see some stuff from Lindsey, which is great. Bob, what about you?
I throw a lot of content out there at explosiveoptions.net. I have a market blast that comes out every morning that it's kind of a recap of what happened the prior day and kind of a setup for the following day. It comes out daily. I have a chart of the week every Wednesday. I have the daily bites, which I communicate out on social media about 8:30 in the morning, Mondays and Thursdays, talking about markets and what might have happened, what's going to happen. And I webinars and so forth. I have a webinar coming up on Thursday. So I'm all over the place, and I'm on Twitter at Aztecs99. I'm also on StockTwits, same Aztecs99 as well too. So I'm flying everywhere, all over, splashed out everywhere. Chris, how about you?
I'm still recoiling from how you're all over the place. But as far as I go, the bread and butter stuff is usually two places. You can go to pro.thestreet.com, where you can find all the musings that I have for the Street Pro portfolio. You can also go to thematica.substack.com, where you'll see some of the thematic models that we have, and some musings there from time to time as well. I tend to pop up in a variety of different places. And while I do have a Twitter account at Chris J. Versace, I'm not the most avid Twitter person. You can find more, in my opinion, some more insightful posts over at LinkedIn. So I would say you might want to take a look for those. But with that, folks, that is the first episode, the begin one, as I like to say, for What Does It Mean? We hope you'll be back next week when we go, as I like to say too, behind the scenes and in the know, sharing our thoughts with you. Thank you so much. We'll see you next week.